Hey, good afternoon. This is Chris Robbins at Robbins Ag Marketing with today's post-close grain and livestock comments for Wednesday, the 11th day of February. Kind of an odd day. I am very interested in watching new crop beans being up above $11, settled up at 11.10 and a half, highest price in 2 months. I think it's a great opportunity for producers. I'm not sure if it's going to last because when you do the math, Brazil's crop's bigger and our grain's more expensive. Yet China is going to buy our grains at a loss. It just doesn't make any sense to me. So I'm happy to see that it's given us a bid in the beans, but I am suspect of it. Uh, Maybe there's other bigger forces at work behind this thing. Maybe there's something to do with, tariffs. If the tariffs ever went away, maybe that would make a difference. I don't know, but it is an opportunity, and please do not miss it because I have no problem with $11 and higher beans. What I don't want is guys to be sitting on sub $10 beans if we get some gigantic crop, and also too if we the wheels fall off of our understanding with China. That's the one thing we don't have anything locked up. It's just um, tweets and suggestions and ideas. So, and they even put that in the USDA report where there's nothing confirmed. So, that's my thought on soybeans. At the end of the day, it's nice to be up here 2 month highs. Another wide trading range. Um, if you look at March with spot beans, traded as high as 28 and a quarter late in the afternoon after trading down to 13. That's a pretty big trading range. And I put this in the letter a while ago. I think you're going to continue to see 13, 20, 25 cent ranges in beans while we figure out what's going on with our demand situation. March corn down a penny and a quarter. I'm concerned about March corn because you know beans are moving higher. There's a good bid there, and there's no follow through with corn. Corn is still struggling. Actually, corn took out a little bit of a trend line support here today. My concern is that where we end on Friday, if we're sub 425 or sub 420 on Friday, that's going to be an ugly look for the week. If you have corn in the bin, you absolutely positively should have a defense against corn falling out of bed because it happens very, very quickly. You've seen that before. You go from, can drop 20, 30 cents very, very quickly. And while people are scratching their head saying, gee, I didn't see that coming, that's something that's true. You never, ever, ever see it coming. I've been doing this for 30 years. Very rarely do you see it coming, quote unquote. Um, Spot beans did not challenge the spike from last Friday up at 37 and a half. It's probably the next target for bulls if we're going to go there. It wasn't that long ago, guys. We were down at 1037. So we had a dollar bounce in spot beans. We are hanging in there pretty good, but we've seen this time and time again where you get a good rally and then it does not last. So take advantage of it. If you've got old crop that you need to move, I really like selling it into a 70, 80 cent rally off the bottom rather than waiting and selling it if it falls out of bed. March wheat Chicago. Um, Push through a little bit of a trend line there. If you're not getting my letter, take a look at it. I do very, very simple technicals. I try and keep it very, very organized. And some people will do technical analysis or charts, whatever you want to call it. And they've got 10,000 lines on their page and say, well, one of these lines is going to work. I try and keep it very, very simple. Simple is better. At the end of the day, these trend lines, they give you a reason to make a decision. That's really why I watch them. Lots of times they're kind of self-fulfilling prophecies where we'll go to this technical area, and you still have to make up your mind if you want to be long or short. There's no magic um, genie sitting out there saying, sell it here, buy it here. You still have to make a decision when it hits those levels. So I'm interested in watching March beans right now. If we can get through 550, there's a little bit of a trend line there, which goes back to last year, and so we'll see. So a good bounce there. If how we settle for the week, I'd love to see us settle above 550. But what's the risk? The risk is that once again, this is a rally to sell. And then the next thing you know, we're back down to 501. So we finished the day at 37 and a quarter, 537 and a quarter. If you're long here, great. You just don't want to be left holding the bag if we take a nosedive and drop 35 cents suddenly. So have a sell stop, have a put, and sit back and see what happens. Soybean meal. I put this in a letter as well today. And again, if you're not looking at the letter, take a look at it. We send it out every day. If you watch the soybean meal, it's also at kind of a critical recovery level. Bean oil hitting a 7 month high. Bean oil has been the one big bull market, and that's something to continue to watch. But it's not really having any follow through on the rest of the complex. Meal is still kind of struggling, but it's had a good recovery. So a lot of you guys out there, I know you feed a lot of meal to your animals. I'm always talking about, how can you position yourself so you don't get run over. March meal finished at 303. Wasn't that long ago, back in November, we were up north of 330. So how do you protect yourself against that if you are an end user? Go buy yourself some cheap calls, cheap out of the money calls. That is your hedge in case prices continue to pop higher. In the protein complex, and we'll wrap it up. Uh, I'm very impressed. We started Monday and guys were talking about we were going to be limit down because of the headlines, the issues about Argentina, the worry that at some point they may reopen the border with Mexico and all that supply comes up here. Fat cattle, April. Uh, Remember how we gapped lower last week on the 4th of February? We gapped lower. We've almost refilled that gap. The gap gets filled if we hit 241.30. And the nice thing about it, if you get my letter, you've got these levels all day long. You can check and see it. You don't have to do the homework. I do the homework for you. But in April fats, the 241.30 is a big target that'll fill the gap. And then we could be talking about possibly re-challenging 245 again. So I'm always interested when a market gets bad news, and you got to say that the news that came out over the weekend about Argentina and what the president said about cattle and everything else, that was pretty bad news. For the market to get that and then shrug it off, that's a sign of underlying strength. So I always like to see that. It's a counter trend, doesn't make any sense. Those are usually the best trades longer term. So I'm not promising we're going higher, but it is nice to see even the feeder cattle managed to turn around today, and we did not take out this week's low. I was very concerned that if we took out 64, we'd trade 360 or 361. That's did not happen today. So same idea goes there as well. Why are we holding a bid despite all these bad headlines? And then if you got to wrap it up, got to talk about lean hogs. Lean hogs is taking the sell pressure in the protein complex. We had a tremendous rally, almost a $19 rally. Once we took out the 25% retracement of that, that has now opened up the door to a 38% retracement. And what am I talking about? Well, you take the low of 81.10 and the high of about 99.80. When we took out 95.50, and that was the 25% retracement, that opens the door to 92.70. And all these are the Fibonacci retracements. The thing people don't like about Fibonacci's is you do still have to make a decision as to which low you're going to use, which high you're going to use. But the way that I use it, right now I would be worried if I'm long lean hogs and don't have a hedge. Could we drop back down to 91 or 88? That's possible. That would be a 50% to a 60% pullback of the last rally. But for now, even if you've done nothing, right, and you feel like, oh, I've missed the boat, 93.85 is still a lot better than 81 last time I checked. So protect what you can with a hedge. I prefer using a put option, a long put option, because you set the floor, you pay for your protection, and then if the market rallies, you're not making margin calls. You're participating in the cash market. And well, that's it for about a Wednesday. I got to talk about the outside markets. The stock market back up there above 50,000. The S&P 500 trading around 7,000. The unemployment report came out today and just caught a lot of people by surprise. Of course, now people start arguing like they always do. They always do. They politicize everything in this country. When we had a Democrat in office, the Republicans politicized their economic data. Now that the shoes are flipped, we had a really good number today. We were expecting less than 50,000 jobs created, and it was north of 160. There's been a big swing in the amount of people that are working in the private sector versus in the government. That's something to watch. Um, but again, I think that surprised a lot of people today. Yeah, there's some underlying things going on there. Big bankruptcies are hitting a lot of these companies out there. It's kind of under the radar. So while you've got the averages moving higher, um, you still have some underlying issues. And again, when people politicize everything, like this is the world we live in with social media, everything gets politicized. Good news can always be twisted to bad news depending on who you're listening to. At the end of the day, though, it was a much stronger jobs report than people expected. Unemployment dropped. And why does that matter to the bond market? Well, that means that the bond market is not pricing in as many interest rate cuts right now, right? Stronger economy, and you saw it with the 30-year, the longer bond here moved today higher when people think interest rates are going to stay put. Um, now, if they had cut rates, then we probably have a different bond market look. So for right now, I would continue to watch that. The market's not pricing in as many cuts. If the economy is hanging in there, the Fed is less likely to cut, at least with our current Fed chairman. So wrap it all up, it means interest rates are probably not going to move that much. And depending on who you are, there's going to be more opportunity here for the rest of the year. I would imagine it's early in the year. If you're a farmer or producer, and if you want some help, some suggestions about when, where, and how to make cash sales, when, where, and how to hedge, how to help manage your net long position. I've worked with farmers and producers since 2010. Prior to that, I spent 22 years trading my own account on the floor of the Board of Trade on multiple markets. But I spent a lot of time trading soybeans, a lot of time trading also the interest rate curves. So those days are gone though. Again, since 2010, I've worked with farmers and producers. The number one thing you need to know as a producer is this: there are people who are willing to take your risk. Let them have your risk. Get your risk on paper. Okay, have a great rest of the day.